Okay, let's just dive right into this explainer because today we're uncovering a dangerous illusion that is quietly destroying financial accounts every single day. We're looking at a massive psychological trap, the incredibly fine line between trading and gambling. It's a fundamental paradigm shift, and honestly, understanding this shift is exactly what separates the pros from the people who end up losing everything.
So I really want you to ask yourself honestly, are you trading or are you gambling? From the outside, the difference might actually be a lot smaller than you think. Both involve putting money on the line, taking risks, and dealing with an unpredictable future. But beneath the surface, the mindset driving these two things could not be more different. Think about two different people who both just bought Bitcoin. On paper, they look completely identical. But person A, they're methodically building a business. They study the market, they manage their risk, they record their trades. Person B, on the other hand, just saw a social media post screaming that a coin is going to 100x, and they just went all in. They both risked money, sure, but one is building a strategy while the other is just frantically chasing a lottery ticket. All right, moving into section 1, the mirror, psychology and red flags.
Let's talk about a feeling we all know way too well. FOMO, the fear of missing out. You know that 2 a.m. panic when a group chat is just blowing up and a coin is soaring? When you frantically buy in with zero research just because you're terrified of being left behind? Yeah, you're not trading. You're reacting to an adrenaline spike. And unfortunately, that almost always guarantees you're buying right at the top, literally seconds before the price crashes.
Then, of course, we have revenge trading. This happens when you take a loss and instead of taking a breather, you just get mad. You immediately open another trade and then another, desperately trying to force the market to give your money back. But here's the really interesting part. That initial loss isn't actually what blows up your account. It's the frantic, emotional death spiral that follows. That's what multiplies the damage.
And, well, we absolutely can't ignore greed. Say you plan to take a 10% profit. You hit it. Awesome, right? But suddenly, greed starts whispering that you're an absolute genius. It convinces you to hold out for 30%. So you completely ignore your own exit rules and you hold on, right up until the market aggressively reverses and wipes everything out. Greed has this nasty habit of transforming a perfectly successful trade into a devastating disappointment.
The market punishes ignorance. That's the hard truth right there. Financial markets literally do not care about your hopes, your desperation, or the fact that your rent is due on Friday. They only respond to supply, demand, and a disciplined strategy. If your strategy is just hoping it goes up, you are gambling. Period. So let's slow things down a bit and pivot. Section 2, the reality check, the professional mindset. Notice the stark difference in focus here. Before clicking buy, a gambler is basically daydreaming, right? How much can I make? Is this going to buy me a new car? But a professional trader, their very first thought is completely different. They're asking, how much can I lose? Can I afford to take this risk right now? Pros prioritize capital preservation and sheer survival over making a quick buck. Think of trading like running a business. Let's say you own a supermarket. You fully expect some milk to spoil before you can sell it. That's not a failure, it's just a normal, expected operating expense. Well, professional traders treat losing trades the exact same way. They don't scream at the market when a trade goes south, they just accept it, manage the cost, and move on.
And how exactly do they manage that cost? With one single, incredibly powerful number, 1%. This right here is the professional's ultimate shield against emotional decision-making. By keeping their risk capped at just 1% on any single trade, they guarantee that absolutely no single mistake is ever going to wipe them out. Let's actually do the math to put this into perspective. Say you've got a $1,000 account. If you strictly risk 1% per trade, a terrible 3-trade losing streak costs you what, maybe $30? You live to trade another day without panicking. But if you're gambling and going all in by risking 50%, you are literally destroying your capital and probably your mental health after just a couple of bad calls. So are you falling into any of these traps? Trading your rent money or emergency savings is incredibly dangerous. Why? Because it guarantees overwhelming fear and catastrophic emotional mistakes. If you're constantly chasing the next big hype coin, ignoring your stop losses, trading just because you're bored, or purely depending on luck, you're basically playing a slot machine. All right, let's get into how we actually fix this. Section 3, the blueprint, building your system. You absolutely have to replace chaotic guesswork with a solid, repeatable process. Step 1. Don't trade 5 different markets at once. Just pick one and master it. Step 2, write down your exact entry and exit rules. Step 3, actually use your stop losses.
And step 4, keep a trading journal. By doing this, you're creating a tangible roadmap that you can evaluate and improve over time.
I really love this analogy. Trading without a stop loss is exactly like driving a sports car without brakes. Look, a stop loss isn't going to magically prevent the accident of a bad trade. You are still going to hit a bump in the road, but it absolutely stops a minor fender bender from turning into a devastating total financial crash. And this really drives home the point that trading is entirely a game of probabilities. It's kind of like flipping a weighted coin. If your system gives you a 60% win rate, you've got a massive edge. You don't need a crystal ball to predict the future perfectly. You just need to execute your system and let the math work its magic over the long run.
Bringing us to our final critical concept, Section 4, protecting your future.
If you want to still be in the markets 5 years from now, you have to completely strip away the intense pressure of relying solely on trading to pay your bills. Never, ever borrow money to trade. Build a separate emergency fund. Diversify your income. Because if your daily survival completely depends on your very next trade being a winner, you are practically guaranteeing you'll make desperate, costly decisions.
Look, the market is always going to be there. Tomorrow, next week, next year, it's not going anywhere. But it's your mindset that determines whether those endless opportunities build wealth or just burn it. Gamblers rely on luck, excitement, and chasing hype. Real traders, they rely on planning, probabilities, and extremely tight risk management.
Ultimately, real wealth is not built overnight by chasing some massive emotional high. It's built by following a system. The disciplined, methodical, sometimes even totally boring execution of a strategy, day in and day out. Remember, a trader follows a system. A gambler just follows a feeling. The market doesn't reward hope. It rewards preparation. So, as we wrap up this explainer, I want to leave you with one final, very real question to think about. The next time you log into your account and see those charts moving, which one are you going to be? Are you going to act on a fleeting feeling, or are you going to execute a proven system? The choice is entirely yours, but choose wisely.